Is every bank in the world insolvent right now? That's the eye-opening declaration made recently by one economist. And while it's an extraordinary claim, a close look at the evidence suggests there might be something to it. Economic uncertainty means you have to keep up with what's happening. Make sure you subscribe and we'll keep you in the know. According to Columbia Business School professor Tomasz Piskorski, there is no mystery to what the U.S. banking system's fundamental problem is right now. A typical bank in the U.S., and there's actually not much variation whether it's big, whether it's small, is about 90% debt funded. Piskorski says that means even a modest decline in the value of bank assets can push a financial institution into technical insolvency. If a wave of depositors suddenly get nervous and show up at the banking door to get their money, like they did last year, then the technical insolvency turns into an actual insolvency. We saw that scenario play out a year ago when Silicon Valley Bank, Signature Bank, and First Republic Bank fell in rapid-fire succession. Fast rising interest rates significantly decreased the value of each bank's substantial bond portfolio, forcing the financial institutions to sell their underwater holdings to meet withdrawal demands. The benchmark federal funds rate remains at its highest level in 23 years. Economist Lynette Zhang says its impact on massive portfolios of government bonds, as well as portfolios on commercial and consumer debt, lead her to one very worrisome conclusion about banks. They are all insolvent, every single one. Popular concerns about banking system instability have focused recently on commercial real estate and the estimated $2.2 trillion in that sector's loans coming due over the next 3 years. Zhang clarifies that the systemic insolvency that touches all banks is not just about commercial real estate debt, but all debt. Not just bonds, not just mortgages. It's also auto loans, student loans, credit cards, and then all the trillions of derivative bets against that debt. Every single central bank, every single commercial bank, all of that debt is underwater. Zhang's suggestion that even central banks have been harmed by their own rate policies over the last 2 years is not a matter of speculation. This includes the Federal Reserve. The Fed suffered its worst operating loss in history last year at $114.3 billion. And through September 2023, the unrealized losses on the Fed's asset portfolio amounted to $1.3 trillion. As of September 2023, the banking system has accumulated more than $1.5 trillion in unrealized rate-related losses on its fixed-rate securities and loan investments. According to AEI, one implication is that more than 70% of the loss-absorbing capacity of the banking system's primary funding source, its Tier 1 capital, has been wiped out. The uncertainty plaguing the financial system is poised to remain a component that experts say is generating significant interest in precious metals right now. In just the last 6 weeks, gold has increased by 15% and silver by more than 20%. What's in store for the banking system and the global economy? Nobody knows. Why? Because of all the uncertainty in the banking system and the global economy. Frankly, in my career, I have never seen anything like it. One fact we all do know is that gold and silver can never become insolvent because gold and silver have no debt. Maybe that's why central banks, money managers, and investors have the perception of precious metals as a store of value and are increasing their positions. That's why I suggest you take the time to learn more about what's really going on in the economy by attending our exclusive one-on-one web conference at AugustaPreciousMetals.com/webconference.